Dear traders, there is a structure sitting on the pound right now that looks outright dangerous, and I need you to pay very close attention because the next 48 hours could define the entire quarter for sterling. Sterling is drifting lower as the Middle East impasse weighs on risk sentiment. But here is what 90% of retail traders are completely missing. That drift is not random selling. It is a slow, engineered bleed directly into a support-turned-resistance trap at 1.3652. A trap that, if it slams shut, unlocks a massive liquidity pool sitting just below 1.3541. And with Tuesday's consumer price index release looming over every tick, we are standing right on the cliff edge. There is one danger zone and one hidden opportunity today, and I am going to map out both of them for you with full institutional precision. I will also give you 3 exact entry and exit levels that you can deploy before the data hits, complete with stop losses and risk-reward logic. Stay until the very end because I am also revealing the one invalidation number that flips this entire structure from bullish to aggressively bearish. Right now, pound sterling to US dollar is printing 1.3643. Let me give you my instant market verdict for this London session. We are still inside a daily uptrend and a 5-hour uptrend, but the velocity of that trend is dying in front of our eyes. The bias is cautiously bullish only if we can hold above 1.3625. That is your intraday invalidation line. Write this number down, write it on a sticky note and put it on your screen. If we break and accept below 1.3625 on a 15-minute closing basis, the entire short-term structure shifts from accumulation to distribution. One moment of carelessness there and the whole rally story evaporates, turning 1.3541 into the magnetic target. Write it down because if we break it today, the whole structure shifts. That is your first interaction checkpoint. I want to see in the comments how many of you had that level already mapped out before this video. Now pull up your charts and let us navigate the technical landscape from the very top timeframes down to the execution zone, because this is where the institutional footprint hide. Start on the weekly chart. The weekly trend is firmly intact to the upside. We have printed a series of higher highs and higher lows that are textbook bullish. But look at where price currently sits. It is stalling right at the 1.3650 zone, which coincides almost perfectly with the 200-week moving average. That 200-week average is acting like a brick wall. Every time institutional money sees price approach a heavily watched moving average of that magnitude, they set up traps. The weekly MACD here is still printing with a positive signal line crossover, but the histogram bars have been shrinking for 3 consecutive weeks. That tells me higher timeframe momentum is intact but utterly exhausted. Exhaustion at a major moving average barrier is not the place to blind buy. That is the place where smart money builds short-term short positions, running stops below recent swing lows before deciding to push higher. Now we zoom into the daily chart. This is where the trend structure becomes actionable. The daily 20-period moving average is sloping up nicely and currently sits around 1.3470. The 60-day moving average is climbing through 1.3320, and the 200-day is way down at 1.2800, which only matters for macro bias confirmation. The daily MACD is still hooked bullish. The signal line is above the center line, but the angle of ascent has flattened. And I want you to focus on the last 3 daily candles. We have a doji, followed by a small bearish candle, followed by a very weak-bottomed bar that failed to hold above 1.3650. That is a subtle loss of momentum. This is exactly the kind of quiet decay that triggers a fast flush before the real move begins. If you are not aware of it, you get caught leaning long right into a liquidity sweep. Next, the 4-hour chart is where the real danger signal is screaming at us. The 4-hour MACD has printed a very clear and undeniable negative divergence. Price made a higher high around 1.3660, pushing past the previous peak, but the MACD oscillator made a lower high and is now threatening to cross its signal line to the downside. Buyers are exhausted. This is the engine room of the trap. We are currently holding just above the 4-hour 20-period moving average, but that average is within a handful of pips and is starting to flatten out. The 60-period MA on the 4-hour is anchored at 1.3590, and that is your first true support floor if the selling kicks in. A lot of traders will try to buy the dip at this 60-period MA without realizing that a break below it aligns with the daily structure breakdown I just described. The interplay here is crucial. On the hourly chart, the picture is even more fragile. The 60-minute 20-period average is already flat at 1.3638. The 60-hour moving average is converging around 1.3610. And the hourly MACD has started to roll over from an elevated reading. The resistance block between 1.3625 and 1.3652 is tight, congested, and filled with failed breakout orders from the last two sessions. That congestion acts as a lid. If you are long here and holding through this technical fatigue, you are leaning against a high probability exhaustion signal. And that is exactly how smart money traps retail longs before a CPI flush. They run price up just enough to draw in the breakout chases, then use the news event to run stops in the opposite direction. It happens every single data cycle. Before we move to the fundamental driver, let me give you the second retention hook because this is what most traders miss when they look at pound setups. They only look at the chart and ignore the cross-asset stress signals that embed hidden risk. Right now, I am watching the US dollar index and the S&P 500 divergence, and I am watching what is happening inside the euro to pound sterling cross because it holds the secret key to sterling's next directional explosion. The dollar index is consolidating right around a critical gamma level, and equity futures are holding fragile gains. If the S&P 500 starts to roll over on Middle East headlines, the dollar will catch a safe haven bid, and cable will be the first to bleed. That cross-linkage is not priced into the optimistic daily trend. It is a trapdoor under your feet. Now let us connect the fundamental driver and the full cross-asset web, because this is where sterling's real story becomes a high-stakes drama. Over the last 24 hours, the pound has been slipping not because of UK data, not because of a Bank of England repricing, but because of a classic safe haven bid into the US dollar as the Middle East impasse escalated. We saw positions squaring ahead of the weekend turn into a residual risk-off bleed at the start of this week. However, that fear bid is fundamentally fragile. It always melts the very moment a fresh inflation print shifts rate expectations. The market's entire focus is lasered on Tuesday's CPI release. A hot inflation print, anything above the consensus estimate, and rate differentials will swing violently in the dollar's favor. The probability of a near-term Federal Reserve cut will be priced out, and that will send cable crashing through multiple support layers. A soft print, however, and rate cut bets will reignite instantly, which would send the pound screaming through 1.3652 as the dollar gets sold across the board. But there is a deeper layer here, and it is the reason I call sterling a dollar killer, alongside the euro, in this current cycle. You must look at the euro to pound sterling cross. That cross is hovering at extreme lows, sitting near the bottom of its multi-month range. What does that tell you? It tells you that sterling's strength against the euro is still fully intact despite today's superficial drift lower. The fracture between the European central bank's increasingly dovish tilt and the Bank of England's relatively firm, higher for longer stance is the gravitational force holding up cable. The bow is being priced as one of the last major central banks to cut aggressively. Meanwhile, the ECB is already leaking signals about downside growth risks. That policy divergence battle is a live wire. Every time an ECB speaker opens their mouth and sounds soft, capital flows out of euros and into sterling, limiting cable downside. But when the dollar flexes on its own safe haven muscle, cable gets caught in a tug of war. That tug of war is why the 1.3541 to 1.3652 range is so pivotal. My 1 to 2 week directional lean remains cautiously bullish only as long as we do not lose 1.3541 on a daily closing basis. That level is the weekly bull flag floor. A daily close below 1.3541 invalidates the entire bullish structure, breaks the correlation with the euro to pound sterling support, and opens the trapdoor straight to 1.3470, which is the daily 20-period moving average, and then potentially to 1.3320. Until that invalidation happens, The buy-side liquidity pools stacked above 1.3700 and extending toward 1.3750 are the legitimate target for any dollar weakness catalyst. Now, I said earlier that 90% of traders miss the hidden order flow trap. Let me expose it right now before we get to the trade setups. When you have a widely anticipated event like CPI, the market often does not wait for the headline to print before it sets the trap. It uses the anticipation to build a liquidity void. Below 1.3541, there are massive stop-loss clusters from late longs who bought the breakout above 1.3600. Above 1.3652, there are breakout stop entries and short liquidation orders stacked. The smart money playbook is to probe both sides, collecting liquidity by briefly piercing those levels, before committing to the true directional expansion. If you do not understand that, you will be stopped out in both directions before the real move even begins. This is why the trigger conditions in my strategies later are so specific. I do not want you to be the liquidity. I want you to be the one providing the exits for the institutions. Most people will click away now because they want the quick signal, but this next section is where money is actually made. Keep watching, because I'm about to serve you 3 precise trade blueprints that account for the trap logic and give you an edge. Strategy 1, the sniper. This is the conservative play for those who demand confirmation before committing capital. The trigger condition is a 60-minute candle close above 1.3652 with genuine conviction. Not a quick spike wick, but a candle body close above that level accompanied by a volume spike or a follow-through momentum bar. Once that happens, you do not chase. You wait for the clean retest of that same 1.3652 level as new support. The market must show you that buyers have absorbed the trap sell orders and are now defending the breakout zone. That retest is your entry trigger. We place a stop loss at 1.3618. Why 1.3618? Because that sits just below the recent intraday swing low and underneath the converging 4-hour 20-period moving average. It provides a logical invalidation point that, if broken, proves the breakout was false. Your initial risk on this trade is 34 pips. The first target is set at 1.3720, which aligns with a prior structural resistance and a measured move extension. The second target extends to 1.3750, which is a psychological level and a major volume node. This setup delivers a 2-to-1 risk-reward ratio on the very first target. The key rule is that once 1.3720 is reached, you immediately move your stop loss to your entry point, eliminating all remaining risk. This setup is only void if price initially spikes through 1.3652, flushes by stops, but then immediately rejects and produces a 60-minute closeback below 1.3625. If that sequence occurs, the trap has been sprung and you step aside. Keep this in mind because the next signal changes. Everything for active traders. Here is your second interaction checkpoint before I give you strategy 2. Type your own predicted pound sterling to US dollar high and low range for the next 24 hours in the comments right now. I am reading through them after the video, and it shows me how aligned this community is with the liquidity zones I just outlined. Drop those numbers now. Strategy 2, the active trader, standard risk. This setup is designed to exploit the pre-CPI drift and the potential for a sharp bounce from a well-defined demand zone. We are looking for a calculated dip into the 1.3590 to 1.3580 area. That zone is a convergence of the 4-hour 60-period moving average and a prior structure support that held price on 2 occasions last week. You do not simply place a limit order there and hope. You must wait for a bullish engulfing candle on the 15-minute time frame to form inside that zone. The moment that bullish engulfing candle prints and breaks its high, you enter long. The stop loss for this trade is placed at 1.3540. That is exactly 1 pip below the key daily support floor at 1.3541, giving the trade breathing room while keeping the risk strictly defined. Your total exposure is 40 pips. First target is 1.3660, the recent swing high and the ceiling of the current congestion. Second target is 1.3720, matching the sniper's first target. Once target 1 is reached, activate a trailing stop of 25 pips and let the remaining position ride. This approach secures a bag while keeping you in the trade for the bigger liquidity grab. The invalidation for this setup is non-negotiable. If a 15-minute candle closes below 1.3541, you exit the trade immediately, no waiting, no hoping. It means the entire lower support structure has failed and the bearish scenario is in play. Strategy 3, the aggressor. This is the high-risk fade trade, and I must be explicit. This is only for those who know how to lose small and manage risk with a surgical mindset. The setup plays on the emotional overreaction that often happens within the first few minutes of the CPI release. If the initial reaction sends cable spiking above 1.3700 on an emotion-fueled wick, you fade that wick. But you do not just blindly short the print. You wait for a sharp, undeniable rejection on the 5-minute chart. The signal is a bearish pin bar or a full bearish engulfing candle that closes back below 1.3695. That 1.3695 level is the top of the broken liquidity zone and must be reconquered by sellers to confirm the fade. Your entry is on the break of that rejection candle's low. The stop loss goes at 1.3735, just above the psychological 1.3700 handle plus a safety margin. The target for this aggressor trade is a fast scalp back down to 1.3650, which is the pivot that would have just been broken. The risk-reward ratio here is roughly 1-to-1, so position sizing must be precise. This trade capitalizes on the classic stop hunt above a round number before the real direction reveals itself. If, however, the 5-minute candle closes strongly above 1.3700 without any wick rejection, you stand aside. The aggressor play has been invalidated, and chasing it would be portfolio suicide. Point 1 sentence to anchor everything. Never risk more than 1-2% of your account on any single trade. Never hold positions through high-impact news without a defined plan, and non-negotiable stop losses are the only thing that separates a professional trader from a gambler. So we come to the final retention loop. What is the one critical level you must carry into the next session like it is branded into your mind? It is 1.3541. That is the floor of the weekly bull flag and the anchor of the entire dollar killer narrative for sterling. Hold it, and we attack 1.3750 with a high probability of reaching those buy-side liquidity pools. Lose it on a daily close, and the dollar killers are dead, replaced by an aggressive dollar resurrection that will rip through everything in its path. Tomorrow, I am breaking down the euro to US dollar setup directly against this exact same pound move, and the divergence there is hitting extreme levels that spell opportunity. That video drops immediately after this one, and you do not want to miss the alignment. If you want the full breakdown on how the US dollar index and the S&P 500 are reacting to the identical CPI event and what the liquidity tide means for risk assets, that video is live right now. Check the end screen and follow the chain. Smash the like button if this analysis gave you a crystal clear plan for tomorrow's open. Subscribe and hit the bell so you never miss a daily breakdown across all 8 key assets. I will see you in the next one.